Okay, so now we come to the real meat of the chapter, and this is what most of your homework is going to be based upon. This question of determining where your cash is flowing. Now, again, we have a cash flow statement over here that we have already computed from our income statement and our balance sheet in combination. And so, it's similar to what we're going to be talking about going forward from here. But again, we need to keep in mind the difference in orientation between finance and accounting. So this is a standardized accounting statement, the cash flow statement or the statement of cash flows, derived by adding back depreciation to net income and then looking at the cash flow results of changes in assets and changes in liabilities. Okay, and if you have a change in assets, if you have more accounts receivable this year than you did last year, then that means that's a negative cash flow from your accounts receivable. It means that you're waiting for more money from your customers. Okay, but our standardized cash flow statement divides up the cash flow in between operating cash flow, investing cash flow, and financing cash flow. Okay, so that is a standard financial statement. The statement of cash flows differentiates cash flows between cash flows from operations, which is your net income adjusted for depreciation, and then looking at the differences in your balance sheet accounts that have to do with operations. And then cash flows from investing, that means new plant and equipment that you've purchased. In this case, if you have purchased new plant and equipment, then that is a negative cash flow because the cash is going out to buy this stuff. And then cash flows from financing talks about how you acquire the money to finance your operations other than just via operations. Right? So in this case, we took out a short-term note payable and we took in $101,000 in long-term debt, which was used to cover this operating cash flow deficit. Okay. So that's a standardized financial report created from the financial statements looking backwards as to what happened with your cash flow last year. Okay, we are going to contrast this with the way that finance people look at cash flow. Okay, and again, this is the heart of this this chapter. Okay, it's a slightly different way of looking at cash flows. Okay, so the first thing is that we have this cash flow identity. That's what these 3 lines here means, right? An equal sign has 2 lines. An identity has 3 lines, and that means that we can define the cash flow from assets as the cash flow to creditors plus the cash flow to owners. Okay, it has to equal these. So I should note, first of all, that we're going to go through a bunch of equations. Okay, but it's not just equations, it is concepts. Although from your perspective, it's probably just going to be equations. And I want to note that here in the book, this last chapter where it says summary financial statements. Okay, if we scroll down, where is it? There it all is. Okay, there's all your key equations are right here. Everything that you need from this part of the chapter is right here in these equations. 7 equations plus this little conceptual flowchart, I guess you'd call it. Okay, cash flow from assets. Cash flow from assets is defined as your operating cash flow minus your capital expending, and we're going to call that CapEx, capital expenditures or capital spending, minus the change in net working capital. Again, I'm going to abbreviate that. Okay. So it's operating cash flow. Now we define that above. All right, so our cash flow from assets, what this means is this is the money that's being generated or used up in the company from the assets of the company. So we've got our operating cash flow, which we defined above, right? Operating cash flow up here is EBIT plus depreciation minus taxes, or net income plus depreciation plus interest. But let's go ahead and use this definition from the little index card here. So operating cash flow is earnings before interest and tax plus depreciation minus taxes. We discussed that above. The capital spending, right? So this is how we determine whether we purchased new capital equipment, which is going to be, of course, a negative cash flow, right? If you bought new equipment, what you do to calculate that is you look at your ending fixed asset account. You subtract from that your beginning fixed asset account, and then you add in this year's depreciation expense. So your change in net working capital is just your ending net working capital minus a beginning net working capital. And then, of course, our net working capital is current assets minus current liabilities. So let's see how that actually looks. So remember, our total cash flow from assets is going to be our operating cash flow minus capital expenditures or new capital spending minus the change in net working capital. So here we calculate our capital spending as 2.579 million, right? So we subtract that from our operating cash flow to get closer to our cash flow from assets. Okay. And then the change in net working capital, again, we look at the, you just calculate the net working capital for the new year, right? In 2017 calculates out to 2270 million. And last year it was 1.048 million, right? So we have more net working capital this year. So if you have a greater net working capital this year than last year, that means you have more money tied up in non-cash current assets, things like inventory, things like accounts receivable, right? So a greater net working capital is a negative impact on your cash. So greater net working capital has a negative impact on your cash from assets, right? So your cash flow from assets is your operating cash flow, which we calculated before, minus new capital expenditures, minus a change in net working capital. Okay, so that's your cash flow from assets. Now, the cash flow that we give to our creditors, right, has to do with both the interest that we pay on any existing debt, and then we have to take into account any new debt that we've taken on or old debt that we retired. Okay, so the cash flow to creditors can be defined as interest expense minus net new borrowing. So cash flow to creditors is interest expense minus net new borrowing. Interest expense is a negative cash flow. Net new borrowing is a positive cash flow. Okay, and in this case, we had an interest expense of 239. And then our net new borrowings is going to be the changes in long-term debt. So here we have more long-term debt, 237 million more in long-term debt and 615 million less in other long-term liabilities, meaning that we have a net negative change in long-term liabilities. If we subtract that negative, right, then that means we add it, right? So subtracting a negative is adding a positive. So our total cash flow to the creditors in this case would have been 617 million, right? So the hard thing here is just keeping your signs straight and thinking about what they mean in terms of cash flowing. And then the third element that we need to consider is cash flow to the owners. Cash flow to owners is defined as the dividends or withdrawals that are paid out to owners, and then you subtract to that. So they've used the term borrowing somewhat incorrectly here in the textbook. I don't like that. I would consider it more of an investment, an inflow of investment capital or contributed capital from the owners. So you just that's very straightforward to calculate. And so then if we look at the cash flow identity, then we have 3.4 million coming in from assets, and then they have to equal the money that is flowing out to creditors and the money that is flowing out to owners. So in this case, we had $7.2 million coming in from operations, but then we used $2.5 million for new capital assets and $1.2 million to increase working capital. When you buy a new capital asset, you almost always have to increase your working capital as well. Think about it. If you buy a new machine, to make beer in a brewery, you also have to buy more, bottles and things, right? So new capital investments almost always come with increases in working capital as well, which are negative cash flows, right? So we had $7.2 million in operating cash flow, and then we used some of that to buy a new machine and to get more working capital. And then paid out $617 million to creditors and $2.8 million to owners, right? And so what this allows us to do is see what's going on with the cash flow of the operation, and again, in a somewhat different way than just in our financial statement of cash flows. And so here is the relationship between this thought process of our cash flows from assets and our cash flows to owners and creditors, right? It is somewhat different from the way that a traditional cash flow statement is laid out. A traditional cash flow statement from your accounting department consists of cash flow from operating activities and cash flow from investing activities. In our financial analysis world, these are both rolled up into cash flows for assets. And then cash flow to creditors and owners, those are both rolled up into cash flow from financing activities. So if we look at a statement of cash flow or a sources and uses statement, which you will sometimes find them called. Okay, here's our operating cash flow, operating activities, our capital spending, here's our investing activities, and then here is our financing activities. So our financial analysis allows us to get to the cash flow statement, but we get there by a somewhat different route, and it gives us different information. Okay, I'm going to stop it here. This one was probably a little longer than usual, and then I'm going to quickly run through just a brief statement about the last couple of sections here in the chapter.